Dale Kudare. We're having conversation in the garden with Bill Johnston, and I'm going to hand this over to him to introduce everybody and the topic.
Thanks, Dale. Hi, my name is Bill Johnston, and I'm the chairman of the board of the Kudare Institute, and we're sitting here in Dale's garden at Villa di Fiore, and the topic today is navigating the current investment landscape, and I have three guests who are going to hopefully make you a lot wiser about your investment decisions. So let me introduce Scott Sandstrom, who is a partner of Spearhead Capital, which is a boutique financial services firm based in Wellington, Florida, that's focused on high net worth individuals and family offices. Scott was previously the founding partner of Bankers Row Wealth Management. Prior to that, he held positions at MLV Wealth and Bessemer Trust Company. Putnam Kling is a director of Spearhead Capital's Wealth Management Division and a specialist in ESG investing. Prior to joining Spearhead, Putnam ran Enhance Advisors in West Palm Beach, where he focused on investments in life sciences, technology, and health and wellness. He began his career in real estate development and has worked for Morgan Stanley. Diego Urrutia is a vice president and client advisor in the Palm Beach office of JP Morgan Private Bank. Preceding his role as a client advisor, Mr. Urrutia was a founder and the chief commercial officer at LoadSmart, a technology logistics startup tasked with reinventing the $700 billion truckload shipping industry. Scott, I'm going to start with you, and maybe you could just give us an introduction to Spearhead Capital.
Sure.
Some people may not be familiar with it.
Thank you, Bill. Spearhead Capital was founded in 2011, actually as a small boutique, trying to create some efficiency and tax transparency in the industry. So we're actually three different companies under one. We have a broker-dealer, we have an insurance consulting arm, and we have a wealth management unit. And part of the reason for that is we want to look at the entire client balance sheet to make sure that not only the asset allocation is correct, but the asset location is correct. And that also has some exemplary benefits when it comes to tax savings and transparency and efficiency of the portfolio construction. So generally run around about $1 billion currently, ultra high net worth clients, not many clients, maybe 30 clients, and oversee about $3.5 billion.
What is
of
the
balance
definition of ultra high net worth these days?
For us, it's probably north of 25 to 30 million, I would say.
That's ultra.
We have probably an average size client in our office down here in Wellington, which is the headquarters, of probably 80 million average size. We have two offices in the Boston area. One is a new hedge fund platform we launched with Life Settlements, and the office in Boston, that is our wealth management in Hamilton, Mass. Probably around 15 to 20 million average size client.
Terrific, thank you. So we'll start with what's going on in the current environment. I must say it's a hard time to be managing people's money because we all know that the market collapsed in the initial stages of the coronavirus. But now it's rallied, I think, 35 to 40% from the lows based on whatever market index you're looking at. And I think a lot of people would argue that the market is simply not reflecting what's going on in the real world. If you look at the real world, everybody's out of work, restaurants are closed, everybody's social distancing. So, Diego, I'm going to start with you. What are you telling your clients these days?
So the truth is, like you mentioned, the market has rallied from the lows. You've seen that in tech and healthcare. But the reality is that we're starting to see airlines coming back, hotels coming back, consumer discretionary coming back. And I think if you're trying to get into the trade right now with respect to healthcare and tech, I'm not going to say it's late, but you might be sort of catching it at the tail end. If you look at, for example, May 13th to today, healthcare and tech is sort of flatlined. Whereas if you look at May 13th till today, what hotels, airlines, and consumer discretionary has done, it's up approximately 30%. Naturally from a much lower base, if you will, given the drawdown it had. Pierpont Morgan once said, the man who bets against his country will go broke, and I truly believe that. I think the spirit in this country is extremely positive, it's extremely optimistic, and you're starting to see it down here. Folks are going to restaurants, folks want to get out, folks want to be active once again, and I think you're going to see it, right? The lag and what sort of keeps me up at night a little bit is the unemployment numbers. I read that about, I think it was 40% of folks making less than $40,000 per year are out of work. I don't like that. So the reality is, I want to ensure, and what I'm looking at carefully is, as the economy does start to come back, the employment numbers also come back with it.
Putnam, let me ask you the same question slightly differently. Let's say a client walked in your door with 20 million, 50 million, whatever, it doesn't matter the number, cash, and say, okay, put it to work. What do you do today?
Sure. So in today's environment, I think we have seen the market really rally strongly off its lows. However, I think you need to own stocks, I think you need to own bonds, and I think you need to own private equity. In a low interest rate environment in particular, I think you're looking at a situation in which people are looking for yield. And in this low interest rate environment, you need to look to alternatives in many cases in order to find yield. I think you also need to, have equities exposure. To echo
Right.
Diego, I think we've seen the tech and healthcare trade work over the last 40 to 50 days in this whipsaw market that we've seen. However, I do believe that there is going to be a new normal coming out of this economy. And what I mean by that is we've already seen some very high profile bankruptcies in the retail space, in the travel space, in the consumer space in general. And I think what's important is that there are going to be companies that thrive and take market share coming out of this, and actually owning individual stocks versus owning the broad market, I think is really the right approach in the current environment.
Give me an example of how you would get yield today. You can't find it in treasuries. High-grade corporate bonds are yielding 2%.
Sure.
So where do you find yield?
I think you have to be very discerning and looking at alternatives and in private equity in order to find yield at this time.
Private equity, okay.
I might also add, given an equity derivative background, you've seen a lot of volatility. So to the extent there's some structured products out there where you're selling volatility, you're gonna get rewarded pretty handsomely. And the reality is, given these sort of lower asset levels, it could be a pretty interesting entry point to get into some of these trades with a significant buffer to the downside. You obviously still have downside exposure should the stock trade below a certain level, but to echo sort of Putnam's point, there are some very bespoke, interesting sort of yielding opportunities out there. You just have to be very selective.
Would any of you sell short in this environment?
I would not.
Why?
Single stock, maybe specific, but not the general market. I would not.
Okay. And does that imply you think there's going to be a V-shaped recovery?
I don't believe there's going to be a V-shaped recovery. In fact, I think the market's taken a little bit ahead of itself on its reaction.
Okay.
I don't, to comment just one thing on the yield, I think it's important for investors as we get in low interest rate environments to also be cautious on trying to reach for yield. There are a lot of vehicles and a lot of opportunities. People piled into high yield bonds. Another classic yield play is a lot of the master limited partnerships in the energy space. I think a lot of people have to be careful when they're trying to replace income for cash flow purposes and getting stuck in some of these investments that yield 8, 9, 10%. And in this environment, in the energy space, some of them theoretically 30% that I doubt will hold.
Theoretically.
And the other issue is, although you get tax preferential treatment in some of these investments, like MLPs with return of capital tax treatments, what you do get is recapture upon sale. So you actually, and that's taxed at an ordinary income level
Right.
versus a long-term capital gain. So there's a lot of people hunting for high yields, whether it be dividend or some other type of distribution element, but they have to be careful about what the other trade-offs and consequences of that yield and tax preferential treatment is.
Would any of you advise your clients to take advantage of low interest rates by borrowing to invest in the market now?
We would. I think that you're going to have some very, very interesting opportunities. I think that if you look at sort of the S&P 500, I think more than 22 stocks are up more than about 20%. You've got about 100 stocks that are down more than 30%. So you have a lot of dispersion. So to the extent you could borrow at very favorable rates and get into a diversified investment, I think it does make sense. I really do.
Okay. Putnam, you're a specialist in ESG investing. For those of us who may not know what that is, can you explain it and explain why you're doing that?
Sure. So ESG stands for environmental social governance. And simply put, it's looking at a way a company affects the environment, the way it affects society, and the way it governs its internal workforce. This has been an area that's grown quite a bit over the past few years, simply because there's been an increase in retail demand as well as an increase in institutional demand. So having spent 8 years in the ESG sector, I've tried to simplify the space. And what I've termed it is life enhancements. So really 3 main questions. Does it improve the quality of life? Does it increase the longevity of our lives? And 3, is the company doing what's right for people and for the planet? And before ESG, it was socially responsible investing. And social responsible investing really removed a portion of the market that they felt were the so-called sin stocks. Well, now ESG has really evolved, and ESG has become a overlay into how the company really conducts business. And life enhancements for us looks at a few subsectors, and these subsectors are gene editing and gene therapy, personalized medicine, artificial intelligence, nutrition and fitness, as well as green energy and green building materials. And in my humble opinion, I believe that this is going to be the best space for growth looking out 10 to 20 years from now. And I think that companies that don't evolve to meet ESG mandates, I think will have a tremendous amount of headwinds going into the future.
Let me ask you a question. BP, the former British Petroleum, stock I happen to own, so I know it pretty well. It's obviously an oil major, but their whole plan for the next 50 years is to get out of oil into green energy, solar, wind, and so forth, and transform itself. Would that pass muster with you because of their plan rather than what they do today?
BP would not pass muster with us yet. However, I would say that if they're heading in that direction and they're really strongly placing ESG and corporate social responsibility mandates on top of their everyday operation, I would begin looking at it. NextEra Energy, Florida and Power Light is a great example, the leading producer of alternative energy in our country. There's a utility company that has taken those steps really over the past decade in order to really become a leading ESG play, and I think that BP has the potential to go that direction.
Diego, what percentage of your clients bring up ESG investing?
So if you look at the family office report that's generated every year, ESG, as you know, is on the forefront. People are talking about it. People want to know about it. Millennials are particularly intrigued by it, you're perhaps more understated. But I'm going to say the performance is fantastic, right? So investors will follow performance, and if you look at the performance in ESG, they've done very, very well, right? And we live in a society that's more and more transparent every single day, and folks expect that of companies. They expect a sense of social responsibility. They expect their company to do right by their community. I think now, given what's happening with COVID, it's just going to accelerate that. So to answer your question, I would say at least 35% of my clients are asking about ESG, and the younger ones even more so.
That makes sense. Exchange traded funds. I mean, to me, that's the big threat to all of your businesses, because it's now easy for someone like me to just say, okay, I'll buy the S&P ETF, I'll buy the biotech ETF, I'll buy the ESG ETF. Do they have a place in your portfolios, or are you making completely bespoke portfolios?
It actually depends. I mean, quite honestly, ETFs, I think, have a particular use for certain investors and can play a very effective and efficient role in doing so. But I do think you have to be careful, again, with ETFs. We do use some ETFs for certain exposures to areas where we don't want a single stock. In our core portfolios, we're generally all individual stocks from a fundamental portfolio. But then we will balance out, as I'll call it, wings on either stylistically on the small mid-cap spaces with some ETFs. The challenge, and it's important again to know, if you go buy an index that is labeled like VO or VB, the small mid-caps of Vanguard that are labeled as that, they actually can get very diluted. And you can actually get wide ranging outside of just the asset class and market capitalization you're looking for. So the other side of ETFs, I think, they are tax efficient. They do offer very low access costs to some investments. Again, the challenge, I can't control taxes, so I can't do my tax loss harvesting as effectively as I would with a bond portfolio or a stock portfolio for a larger client needing some tax neutral trading. I also can't really control the asset allocation nor exposures because it's basically in a swath of a fund. So what we've done when we use ETFs is we've actually broken out the small mid-cap space and actually found what we believe are ETFs with pure integrity on. If it's a small cap value, nothing but value in small cap is in that. And we use those, but you do have to go searching because a lot of them have bled across the lines and have blurred.
Right.
Quite candidly, we know what they don't want to do is they don't want to sit there and have to keep changing from mid cap to small cap to large cap and back and forth. So they tend to actually get pretty wide ranges of what can be in there, and that can dilute the overall asset allocation from a target from our standpoint.
Bill, I might add that we're really in the business of giving advice, right? We advise our clients, and the reality is that today more than ever, given the amount of information we have, I believe that advice is even more valuable. So to Scott's point, ETFs can play a vital role in the portfolio, right? To the extent they provide the correct, cost-efficient allocation and exposure a client is looking for.
Right.
To give you an example, the SPY, I believe, charged around 8 basis points, and it's a decent sort of vehicle to get exposure to the S&P 500. JP Morgan, obviously, given our size, we were able to negotiate with Fidelity to have exposure to the S&P 500 via 1.5 basis points, right? So again, to the extent you're
For those of you who don't know, that's nothing, basically.
that's very, very low,
Yeah.
but it does take away from our clients' performance. So it's very important to us making sure we identify the correct and most efficient vehicles to give clients exposure to what we believe is the correct asset allocation. That's at the core of what we do.
Agreed.
Okay. New topic. We have an election coming up, and I think everybody would agree that there's a huge difference given the result of a Biden presidency versus another 4 years of a Trump presidency. And I guess another variable one has to look at is who Joe Biden picks as his vice president, which will signal the direction his administration will probably go. How are you guys factoring in this election into your thinking? Putnam, you want to start?
Sure. So I think it's very important that investors understand the policies of both candidates. I also think it's very important that they understand the tax policies of both candidates. In my universe and in the portfolio that I run, I do not let political elections, affect my long-term investment philosophy. I believe there is such a demand and a force behind the ESG space in particular that regardless of who is elected president, I don't think it changes the landscape all that tremendously in a 5 to 10 year outlook, which is what I take in our portfolio.
Scott, would you?
We do obviously watch political elections. I think they can have material impacts on people's wealth and plans to create and preserve wealth. But I actually think this year the challenge has been the coronavirus has actually kind of muddied the waters. And as we've seen kind of less political discussions going on, except for bantering back and forth about how anybody's handling things. So I haven't heard much substance out of either group to really understand where anybody's really going yet, outside of just knowing their
They don't like what
baseline
the other
differences.
guy's doing.
Right.
Yeah.
So I think it's a little challenging. We do try to make sure that obviously there are areas of the market that can be very materially impacted by government intervention and regulation. I mean, we've seen what happens in Europe with GDPR and finding Google billions of dollars. We've seen Google's up on the DOJ's radar right now for potential anti-competitive acts. Those things obviously can have big impacts on companies. However, from a wider swath, I think it's too soon, at least in my opinion, it's too soon for me to make any determination because I haven't heard enough substance of exactly what's going to be anybody's plan yet. And then I can make a determination on the effects on the
Well, you
market.
hear bits and pieces. For example, Joe Biden was on CNBC the other day and said that if I'm president, I'm going to make sure Amazon pays the taxes it owes.
Right.
Which to a lot of people is a scary thought because they clearly are paying the tax they owe and they're taking advantage of the U.S. tax code. So maybe what Joe Biden meant to say was, I'm going to change the tax code.
And I think
So go ahead.
Yeah, no, and I think he is doing that, right? I think his proposal raises the corporate tax,
tax,
right?
yeah.
His proposal also eliminates the capital gains tax and makes it income tax, which is substantial, it's material. If you look at his spending, he's talking about healthcare, he's talking about infrastructure. So I sort of echo Scott's points. I mean, it will affect portfolios, especially in the short run, no doubt about that. To the extent you're invested in the long term, I think ESG is a fantastic place to be because they will navigate those waters, I think, very effectively. But the truth is that, in my opinion, should we see a Joe Biden election, I think U.S. equities will take a bit of a hit. Maybe it's the year for international equities. We don't know. We've been saying that for a long time. We all want international equities to do well. Hasn't happened just yet, but it could be that. But the truth is that yes, I think it could have a material short-term impact. But again, it goes back to our role, and it goes back to advice, and it goes back to the core of what we do, right? And that is help you navigate the ever-challenging landscape, right? And we generate returns really via two methods. Number one, helping you be allocated to the correct sector, to the correct place, being in the right area, if you will. And the second thing is finding the correct vehicle to give you the most effective and efficient exposure, right? And we do that on a continuous basis. So both of our firms are well prepared to address a Joe Biden presidency.
I know JP Morgan is clearly a global investor. What is your firm's philosophy about investing overseas?
Investing overseas, it really depends on where you're asking. I mean, there are times we have clients obviously ask us about emerging market exposure, whether you're looking at BRICS, whether you're looking at frontier markets. We actually are not as positive on international equities for the last year. We have actually trimmed our weight over the last 12 months to international equities. I know on certain valuations you can make very good cases, and on, again,
Right.
individual selective stocks, you can find some very good purchases. But as a, if you're looking at developed Europe as a whole or something like that, I'm not a fan right now. I do think that when you followed the Brexit situation, the euro has always been a disconnected economic situation of who actually, it's not an equilibrium of everybody coming economies. So I have basically certain people subsidizing the rest of the euro, whether it be Italy or Greece or something like that. And then if I have UK come out with a Brexit, I absolutely do believe that any deal that the UK makes post-Brexit is actually going to involve and somewhat benefit the United States being such a large global trading partner. So I don't think that Euro ex UK is actually very attractive right now outside of what the valuation numbers may show.
How about Asia?
Asia, I am not touching Asia right now. I'm sure you probably saw there was something that just went before Congress and is sitting, I think, in front of President Trump's desk about delisting ADRs. So if you're looking for trading on the international exchange locally in their currency, maybe that's a different situation. But Asia has been challenging for me due to in my perception of the cleanliness of some of the numbers. And the other part of that, I think, is because there's so much that is difficult to understand how much is private versus quasi-public.
Yeah.
It's difficult for me to understand the validity of the earnings, if there are earnings, and as it pertains to U.S. exchanges buying ADRs with the potential thing in front of Trump on delisting them. I don't want to get access through any of those mediums.
What about cryptocurrencies? Do they have a part in any of your clients' portfolios? You want to start, Dan?
So I'm very intrigued by it. I think when Paul Tudor Jones went out and said that it could be the most impressive speculative trade of the century, I think he said his lifetime. That was quite interesting. So I've done a bit of research on it, and I can see the intrigue in it, right? And I like to take a step back and not talk so much about Bitcoin, but talk more about the concept of technology evolving, the concept of digitalization, and it's hard to grasp in the very beginning, right? If you think about the internet, if you think about email in 1992, it's a very challenging concept to understand, right? You had telephones, you had faxes, you didn't really need it, if you will. But what you see about technology is when it takes off, when it gets a footing, there's no stopping it, and it evolves quickly. So I think we're still in the very, very, very early innings of cryptocurrencies. I do think there is a role for them. I believe JP Morgan is now working with Coinbase and Gemini. We're not endorsing it, if you will, but we're collaborating and we're willing to learn more. Goldman Sachs came out with a letter yesterday, I think, saying that they were definitely not endorsing it. They were not really on board. But it definitely makes sense, I think, at this juncture to try to understand a little bit better. They've got the 21 million, Bitcoin's got the 21 million limited quantity of Bitcoin, which does create a certain amount of value. And you're seeing more and more very intelligent investors getting into it. So I wouldn't say, to answer your question, I wouldn't say today I'm recommending it, but I'm definitely very intrigued by it, and I'm trying to learn more and more about it every day.
Putnam, if one of your clients came to you and said, I think I want to put Bitcoin in my portfolio, what would you tell them?
Sure. First of all, I don't advise on cryptocurrencies in my profession, but I would say it warrants a conversation. It warrants a conversation because some very smart money has recently gained exposure to it. We've seen the Fed throw the kitchen sink basically in monetary policy, the long-term effects of which I'm not sure that we fully understand because we've yet to see this actually play out in the past. So the fact that Bitcoin, for example, is a finite, has a finite cap on the amount of Bitcoin that will ever be mined or ever be issued, makes it intriguing. Some would almost call it, they would call it crypto gold, for instance. They would compare Bitcoin to gold given its finite qualities. As a young man, I've been following cryptocurrencies since 2017 because all of my friends want to ask me about what I think about crypto. But at this point, I think it warrants a conversation, but I'm not advising on it.
How closely do you guys follow the Fed? Because the big mystery to me personally is how we can do all this deficit spending, and the deficit is just blown out, obviously, with coronavirus. And the U.S. government can borrow for 10 years at, what is it today, about 0.6% for 10 years? And if you put it another way, you think about it for a second. Okay, would you lend the U.S. government, give them your money, and get 0.6% per year for 10 years? Does that make any sense in this environment? How do you react to that?
Yeah, I mean, it's if you look at the stimulus package and you compare it to what we did in the global financial crisis, it's 3 to 4x that amount. I think the administration moved very, very quickly to address the situation. Obviously, now what we have is this ballooning deficit. But if you look back in history, I think the way it's been addressed is not so much paying down the debt, but actually growing the GDP, right, through GDP growth. And provided we remain within certain ratios, certain levels, I think we're going to be all right. We have a fantastic economist and market strategist at JP Morgan, Michael Sembalest, and he's actually talking about deflation, right? He's thinking, I'm more concerned about deflation, given what companies are going through in the public and private companies, giving restructurings, giving unemployment. And people have been talking about inflation for a long time now, and it hasn't materialized. So I think in the short term, we're more watching closely deflation.
Scott, do you share that
I
point of
actually
view?
agree 100%. I think, if you look at Chairman Powell's actions, I think we pumped in approximately, whatever it actually hit the bottom versus the $7+ trillion that's been put out there in various forms. It's an extraordinary amount of our economy. However, I agree 100%. I think deflation is a far more dangerous thing to deal with than pumping a bunch of inflation into the system and hopefully getting some inflationary pressures to come about. As far as we've been looking at that long-term 2.3 standard core for a long time, and it's been very low, under 2 for quite some time. And I think that's also as a result of the fact that we have China and emerging economies have been pumping out deflation across the globe for decades. So I think it's, for our standpoint, inflation in this environment could be a little healthy measure. And I think what Powell's doing is actually the appropriate measures right now.
Yeah, I used to work with Jay Powell back in the 80s, back when interest rates were real numbers like 5 and 7%, and there was inflation. So that's where we both came from. But he's obviously adjusted to it very well. I'm still trying to get my arms around it. I think we probably ought to wrap it up now. I want to thank all three of you guys. You've been great, and we're glad to be here to support the Dale Kudera and the Kudera Institute. And it's hot here in this garden, and we're social distancing. But anyway, thank you all very much, and
Thank you.
it's a wrap.
Thank you very much.